Welcome back in YouTube. So Palantir just reported earnings. I don't even know what happened. We're going to break into this one really quick here, as this is a very heavily followed stock. I think this company is pretty innovative overall, but I also think it's pretty expensive. We've had a 1-year price target on this stock for about $6 a share. So on our watch list, we have Palantir at $6 a share, currently trading a little bit low here after they've reported, down roughly 1%, sitting at $7.84. We have a 52-week high on the stock at $27 and a 52-week low at that $6.44. Guys, when I say $6, I'm basically saying anything below $7. I think you can start looking at Palantir as a possible speculation play here. Definitely a lot of concerns that you have, not from the company perspective, but the fundamentals of the company, of which kind of premium you're paying for here. A $16 billion market cap on a company that really is burning capital, and it's been around for a significant amount of time. To me, there are some risks here with this company, but I also believe it to be an innovative company and have some tremendous opportunity ahead. Palantir misses earnings estimate and revenue outlook looks a little light due to currency. Now, this is something we've been talking about across the board, ladies and gentlemen. We've been discounting a lot of stocks because of the strong dollar. That's something we do on this channel. We make sure we build that safety in there. Now, once the dollar weakens, we obviously know there's going to be opportunities in emerging markets, and that's essentially what we're waiting for here. We're waiting for this dollar to get weaker, and if the United States does head into a recession, it's going to lend some opportunities, in my opinion, for the emerging market. The reason why I've only had a $6 price target is when I run my analysis, ladies and gentlemen, I took in consideration the amount of stock-based compensation that they were having and the fact that revenue was going to be hard to maintain these revenue growth rates in a contraction period of an economic cycle. So revenue grew 22% year over year. Now, this is a company that's supposed to be growing over 30% when we're talking about paying for the premiums that we were paying for on Palantir. It's been a 16 to $20 billion market cap over the last 2 years. And in order to maintain those market caps, guys, you have to be growing over 30%. Otherwise, it just makes a lot more sense to invest in companies like Amazon and Google, who have the ability to grow just as strong, but have the balance sheet and are not diluting as much. U.S. commercial growth at 53% year over year, very strong there. U.S. government revenue grew 23% year over year. So we're starting to see that the segments of the commercial aspect is growing, and that's what we want to see. We don't want to see them too reliant on the government money, but hey, it's nice to get those government checks, isn't it? Customer count grew 66% year over year and 11% quarter over quarter. Very, very strong there, actually. So when I'm seeing these growth rates here, I'm really wondering where the disconnect is in Palantir's earnings, and we're going to get down to that here in a second. Loss from operations of $62 million. Now, guys, this is a company that should be free cash flowing, should be going in the positive direction. They've been around for a significant amount of time, and yes, they are spending, and yes, they are still growing and in the growth phase. It would be nice to start seeing share dilution slow down and them to at least start squeaking out some real cash flows. Their margins right now are negative 13%, which is up 1,000 basis points year over year. So they are trending in the right direction. Right off the bat here, we see that top line revenue growth is about in line with expectations. So they are growing right around that 30%. Guys, nothing I'm seeing bad here on the revenue and gross profit so far. Little kick up in sales and marketing, a downtick in research and development, general administration. But loss from operation, guys, it went from 91 million quarter over quarter to 62 million. So it is trending in the right direction. And over the last trailing 9 months, we can see here a big difference. So as much as I'm dogging Palantir, or it sounds like I'm dogging Palantir, they are heading in the right direction. Until we get to other expenses here, huge jump in other expenses, going from 11.2 million to $260 million of other expenses, coming down to $398 million of other expenses versus 365. So once again, little tick up there as well. And of course, guys, the one thing we have to keep looking at is going to be their share dilution. It's just nonstop with the share dilution. I mean, look at this jump going from share dilution, going from 1.8 billion, call it 1.9 billion, to 2 billion and 73 million shares. This is a lot of shares to be putting on the market here, guys. And I understand the story about the stock dilution, okay? Whether you want to talk about them using it for stock-based compensation, That's fine. That's all fine and great. But the problem is people that have bought the stock at $25 are still getting diluted as they're losing more and more money. So essentially, for the person that has bought the stock over $20 a share, not only are you losing more per year now, but you're also losing more because they're diluting you more. So now there's multiple aspects to why your share is worth less. We do see a nice tick down in stock-based compensation going from 184 million to 140 million. So even though they lost $62 million after adding in the stock-based compensation here, they get an adjusted income from operations of $81 million, which is about 17% adjusted gross margins. And this is absolutely a problem, ladies and gentlemen, because when we were running our analysis, we were saying that 30% growth rate and 30% margins is about what we were expecting with a company like Palantir, and now that is getting absolutely cut in half. They are losing money, okay? Loss from operations is 62 million. And they are putting back in stock-based compensation. When we bring it all down to the end of the quarter, once again, their net losses are negative $123 million. They add back in stock-based compensation. We get the adjusted net income of 16 million divided by the new shares that are outstanding, which, guys, take a look at this. You know, I would be pretty upset with this. You know, the dilution of these shares are just, it's annoying. It's almost another 20 more million shares on the market, right? And now you get a positive adjusted earnings per share. The true earnings was negative 6 cents a share. After adjusted earnings per share diluted, they got it to 1 cent a share. Guys, I'm going to use a 32 EV to EBITDA. And once again, oddly enough, this gives us a $6 price target once again. So that's what we get for an EV to EBITDA of a 32. Now, I guess you can give it a little bit more of a premium and say maybe it's closer to a 40 EV to EBITDA multiplier. That gets us a $7.39 stock. I want you to understand when you're using these higher multiples, you're taking on a lot more risk with this valuation, as we don't know what the company's true growth rate's going to be, as it has come down substantially from over 30% growth to now it's doing roughly 22% growth. Also seeing that margins are still in the negative. It's pretty unclear to when this company is going to be able to shift margins to the positive and if they're going to be able to maintain this high growth rate. That being said, me personally, I'm going to use a 30 EV to EBITDA just to err on the safe side. I basically get between a $5.60 stock to a $6 stock. So, you know, somewhere in the middle. I'm still going to keep my $6 price target personally on this stock. If it breaks below 6, I'm really interested in this company. Even if it gets into the low 6s, I might start nibbling a little bit, as I do think they're innovative. There is a possibility that they can continue this strong growth rates. But there is obviously a lot of concern, as we saw through the financial statements. As always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you next time, investors. Peace.